All right, we're going to go ahead and get started. Welcome to our mid-year webinar. I know it's already early August, but we got to June 30th, created the webinar, got it through compliance, and had some time to invite people. So even though it feels like we're 6 weeks into the second half of the year, we hope and believe that this is still going to be really timely information for Nathan and I to share with you today. So for those of you who don't know me or don't know me well, I'll pass along some information here. I'm Jesse Hurst, certified financial planner and CEO, senior wealth manager and CEO here at Impel Wealth Management. I've been doing this now. This month makes 36 years that I started doing this. So a couple of years I've been at this. And as you can see here, we really focus at Impel Wealth Management on helping people make a successful transition from work life to a life of meaning and purpose in retirement. So with that, I will also pass along here and let Nathan spend a moment and introduce himself.
Yeah, hi Jess. I'm Nathan Alish, and I'm a certified financial planner and senior financial advisor here at Impel Wealth Management. Actually, I just celebrated my 5-year anniversary at Impel, so I'm a little over 10 years in the business, but in June of this year, celebrated 5 years since I joined the team. And prior to that, I was an advisor at another firm, and I was an Army officer prior to that as well. And as Jess said, one of the things that we really like to focus on is getting to know our client and what's most important to them, and how can we really help them take their hard-earned resources and help them accomplish what's most important to them and their families in life. So
yeah, and I want to just share with you, because usually Nathan and I, put on a jacket and really dress up for this. But today, Impel Wealth Management was the title sponsor for Senior Day at Soapbox Derby. So a number of people from our team spent parts of the day out at the Soapbox Derby Hill, and I think there was something north of 350 people, 60 and over, who got to have the thrill of the hill, as they call it in Akron. So we had a great time today, but we're in our polo shirts and khakis today, and I hope you understand why. So with that, we're going to go ahead and get started. One last housekeeping note: I did want to let everybody know that for all of you who are clients of ours that are watching today, you're going to be getting an invitation for this. This is Bill Bush and Pete Bush, who are my business partners down in Baton Rouge. A lot of you have heard me tell stories about Pete, and from Pete for years and years. Pete's been one of my best friends for more than 20 years. On Tuesday, September 26th, they're actually coming up. We rented out the Quaker Square event space. And last year they wrote a book. I got a copy of it here, The Runway Decade. And the basic premise of the book is for those people who, once you hit your 50s, you've got about 10 years of runway left before you take off into your retirement journey. And they're going to come in. It was an Amazon bestseller last year. And they're going to come in, do a talk on the book, do Q&A with the audience, sign copies of the book for people. So we're really looking forward to having people there for that. So be on the lookout, mark your calendars, and we'll probably remind you here before the end of today about it as well. So as we turn to our information today, and as usual, Nathan and I will take 30, 40 minutes here, 30 minutes hopefully, and kind of walk through the economic, backdrop and information we wanted to share with you. And then what we'll do is, open it up for Q&A. So if you have questions, there should be, if you move your mouse or cursor over either the top or the bottom of your screen, there should be a toolbar that comes up. Make sure you put your questions in the Q&A, not in the chat. So we have somebody monitoring that. Well, Nathan's monitoring that for us, and we'll feed some questions to us here at the end. So with that, it's kind of like in the first half of the year, we started out with everybody on recession watch. Everybody thought with the Fed raising interest rates at the most aggressive pace that we've seen since the early 80s, that a recession sometime this year was inevitable. And now we're seeing a number of those recession calls either pushed off into the end of this year, first part of 24. Some people are kind of hesitating whether we're going to have a recession or not, or whether we're going to have kind of these rolling recession scenarios that we'll talk about a little bit. But most people thought we were going to at least have a lot of volatility in the markets, right? And with the economy slowing, with geopolitical events, right, with the Fed continuing to raise interest rates, with inflation still coming down, but still elevated above Fed targets, with especially some of the events we saw during the over the last 6 months, right? And that includes regional bank failures. That includes the debt ceiling debates that occupied a lot of the financial oxygen in the air during, April and May, until it was resolved at the last minute. And then just last week, we had the downgrade of the credit rating, the U.S. credit rating by Fitch. And we would have thought all of those things would have caused a lot of volatility in the markets. And quite honestly, what we saw was fewer days where the stock market moved up or down by 2% or more than we'd seen at any time since 2017. So it's kind of unusual to think of all of those headlines happening, but yet not having elevated volatility. Now, we still think there's a high probability that the volatility will pick up in the second half of this year and maybe into next year as we head into a presidential and congressional election year. But the things we're really focused on in the second half of this year, right, is going to be the economy, corporate earnings, and how the market responds to those. And that's what we're going to focus on during today's webinar, right? So it's kind of interesting as we look at the economy, the first of those three main bullet points that we want to cover today. The economy has reopened, post-COVID. Everything's wide open. If you go to restaurants, you go to concerts, you go to sporting events. If anybody's been to an airport lately, they're wide open and they're packed. And there's been all kinds of travel, inefficiencies going on and challenges going on. I could give you a couple stories about trips Rochelle and I have taken over the last few months that have had some challenges and so forth. And most people were expecting that as the economy slowed because of the Federal Reserve Bank raising interest rates, that you would see a recession at some point. And now there's a few more people saying, hey, maybe we won't have a recession. Maybe we'll have this idea of what's called a rolling recession, where different parts of the economy go through downturns, but the whole economy doesn't go through a downturn at once. And we've already seen some of this, right? We've seen housing last year, residential real estate went through a real slow period in the latter half of last year as mortgage rates started ratcheting up from 3% or less to 6% or higher. Today, the most recent numbers I saw earlier this week was that the national average for a 30-year mortgage was up slightly above 7%. So we also saw it in automobile sales. The manufacturing part of the economy, according to manufacturing surveys, has been in recession for 5 or 6 months now. And everybody expects commercial real estate, especially as it relates to retail and office space, with everybody working, with a lot of people still continuing to work from home, to see a lot of trouble with what happens in the commercial real estate market space. But these may be pockets of weakness that don't all occur at the same time. So it may be kind of this rolling recession that hits different sectors, but there's a growing school of thought that we may not have this massive downturn that hits all at once. And that's despite some things we're going to talk about here in just a minute, which includes the inverted yield curve, which has preceded the last 7 recessions. And our yield curve has been inverted now since last July, August, so for at least a year now, and what the index of leading economic indicators is showing us. So as we take a look at the impact of higher interest rates, we can see now, and there's been one more interest rate increase just in the last couple of weeks since this slide was created, and you can see here that we now have interest rates that are above where they were in 05. They were equal when this was done, but we're now at the highest interest rates that we've seen since 01. And you can see that as interest rates go up and the Fed funds peak, they typically are followed by these gray bars, which are recessions. Now, those gray bars happen after the Fed starts raising rates because it generally takes 6 to 9, some people think 6 to 12 months for the economy to feel the full effects of these higher interest rates. Higher interest rates act like a brake on the economy, right? So when you have a brake, the Fed is applying a brake because when mortgage rates go from 3 to 7%, now it makes it more expensive to buy a home. When automobile interest rates to borrow money to buy a car goes from 3 or 4% to 7 to 9%, it makes automobiles more expensive. Therefore, people can't afford as much and think more before they buy. That tends to slow the economy with a lag effect. But just to remember how big that lag effect can be and how quickly the Fed raised rates, and you can see, kind of this stair-step approach that the Fed took back here in 04 to 06, and how quickly, at least in that mid-range from June through November of last year, how quickly interest rates rose. Just remember that in June of last year, so just 14 months ago, the Fed funds rate was still just down here at 1%, right? So if it takes 6 to 9 months for these higher interest rates to work through the economy, that even though those rates are at 5.5% today, it was just 14 months ago that they were at 1%. So that impact of the higher interest rates slowing the economy is still largely yet to be felt. The second thing that I wanted to bring up here was the impact of the index of leading economic indicators. So the index of leading economic indicators, which is put out by the Conference Board every month, tracks 10 indicators that look forward, kind of project where the economy is going to be over the next 3 to 6 months, over the next 6 to 9 months. And again, you can see from history, and this chart goes all the way back to 1960, when you see these big drops in the index of leading economic indicators, they're generally followed by these gray bars, which again are recessions. And we've never seen a period of time where the index of leading economic indicators dropped this significantly without being followed by one of these gray bars or recession periods. Now, historically, we've never seen the index of leading economic indicators drop more than 8 months in a row without being followed by a recession. The index of leading economic indicators has now fallen 15 months in a row, something that if we avoided a full-blown recession would be unprecedented. There'd be no historical comparison for that. So, generally it's 8, 10, 12 months after the index of leading economic indicators starts dropping that you see a recession come, which tells us that we could be or maybe should be on the doorstep of a recession at some point in the very near future. The other thing that I want to address, right, and I'm going to pop off a screen share here for just a second. This chart basically shows when banks start tightening their lending standards. It's a bank loan officer survey, and it shows, and you can see this data is actually from March 31st. They only put this out every 90 days. And we didn't have June 30th data yet when we put together this slide. So remember what happened when we went through, whoops, hit the wrong slide there. All right, so what we saw happen, remember this, that back in March and April, we saw 3 regional banks fail, right? We saw Silicon Valley Bank, then Signature Bank, and then a few weeks later, it was First Republic Bank. Now, we know from history, right? If we look back to the savings and loan crisis of the late 80s, we know that when that happened, banks tightened lending standards and that slowed the economy. It meant it was harder to get credit. It was harder for businesses to get credit for expansions of plants, equipment, technology, hiring people, and so forth. We also know that when we went through the 07-08 financial crisis that led to AIG and Lehman Brothers failing, led to the government takeovers of Fannie Mae and Freddie Mac, and also the subprime mortgage crisis, that bank lending standards tightened significantly. And when that happened, that slowed the economy. We know there's a lagged effect. So remember, this only happened, 3-4 months ago in March and April, 4 or 5 months ago. And it generally takes 3 to 6 months or more for this to start working through the economy. So at this time, you already had the Fed putting one foot on the brake by raising interest rates. And the thought is, as lending standards tighten, it will be like a second foot being applied to the brake and slow the economy even more, which will cause a further downturn in leading economic indicators and so on. So those are things that we really have to take into account as we look at the economy and where it may be heading, right? By the way, if you want a really good primer on, and kind of an entertaining primer on what really happened during the 07-08 subprime mortgage crisis, right? There's a movie called The Big Short. A lot of people have heard of it. It starred Ryan Gosling, long before Barbie. So Ryan Gosling, Steve Carell, Christian Bale. It is a fascinating and somewhat entertaining look at what happened behind the scenes the last time we went through some bank turmoil and so forth. So with that, the next thing we want to talk about here is the rolling recession, right? This shows how new home sales that were at kind of like all-time highs, selling at 1 million, 1.1 million seasonally adjusted sales, dropped down significantly last year. And remember how we talked about there's this potential of a rolling recession, whether it's automobiles or homes or manufacturing. This is just illustrative of how this has happened with new home sales. So you have new home sales falling dramatically, but then picking back up. And part of that picking back up is people realized, hey, mortgage rates aren't coming down. They're not going back to 3%. One of the things Nathan and I, and I'll stop sharing here for just a second again. Nathan, how many clients have we had that have told, especially clients that are in their maybe 70s or older, talk to us about how, interest rates at 7% aren't really that bad compared to when they bought their first homes.
Right. Yeah, absolutely. That's actually, I think when you look over a longer period of history, 7 isn't really that obscenely high. I think what's really been the sticker shock has been, frankly, for people more of my generation, right? When for much of, if you were looking to buy your first house from the mid 2000s to now, all you've really known is probably something that was 5.5 or lower, right? So the notion of 7%.
It's kind of funny when you think about it. It's kind of like the 3% mortgages were really the kind of more abnormal when you look at mortgage interest rates over the last, 60, 70, 80 years, right?
Yeah, absolutely.
And it's kind of funny. I know Nathan's had stories like this, but I've had clients say to me, not long ago, I had one of my clients who bought their first home in 1982 look at me and go, I don't know what these kids are complaining about today. When I bought my first house in 1982, my mortgage rate was 14%. And in 1992, I was able to refinance for 8%, and I was thrilled. So I don't know what these kids are complaining about at 7%. So, it's just kind of funny when you put some historical perspective around that. But so we see that home sales are picking up, and one of the things that's really interesting is there's very little inventory on the market. So housing prices have remained elevated, but when you take a look at the percentage of home sales that are coming from new home sales versus existing home sales, historically, new home sales have averaged about 15% of all home sales. It's more than double that right now. And the big reason for that is, and I'm going to jump back off this for just one more time, maybe let Nathan share a little bit about this, but how many people, especially young families that are out there with a mortgage at 3 or 3.5%, are anxious to even if they want to move to a nicer, bigger home, how anxious are they to move to a 7% mortgage?
Yeah, I mean, obviously they're not, because when you look at over the last 3 years, essentially coming out of COVID, when home pricing has gone up by ballpark 35% nationally, even in the Northeast Ohio market, it's still north of 30% of price appreciation over the last 3 years. And when rates have gone from, call it 3 to 7, and the home went from 350,000 to 450,000, that's painful, right? So a lot of my younger clients, they call they're rate locked, right? Where they can't move, or they feel like they can't move because they don't want to give up the 2.75 or 2.85% mortgage to go to a 7% mortgage and pay $100,000 more or whatever for the house. So.
Right. And so I think between higher home prices and higher mortgage rates, we've seen the typical mortgage payment go up by almost 80% compared
that's right.
to where it was 3 years ago. So all of those young families who are just staying put and not looking to move is leaving very little existing home inventory on the market. And again, since there's so little inventory, every home that comes on the market, you have more buyers than sellers, and it's keeping home prices elevated, which is very different than what we experienced back in 07, 08. So with that, another example here is what we see in home sale or automobile sales, right? You see automobile sales drop down to around 13 million units a year in 2022, 21, 22. Now, a lot of that you can see down here at the very bottom in late 21, early 22 was supply chain issues. We couldn't get parts. How many car dealerships did you drive by and they just didn't have anything on the lot? And you can see from the blue line that that's picked up to about 15.5 million units now. Now, it's not anywhere near the 18 million units, 17, 18 million units we were selling before, but this is another example of something that kind of went through a downturn and is already bouncing back out, even without the full impact of the of a national overall economic recession. Last slide that I have before I turn things over to Nathan. Most of you know that my son Shane was a touring Broadway actor, and when I looked at this slide the first time, I saw Les Mis, and it's not Les Mis, it's Less Miserable. So it's less miserable. There's this thing that was created back when Jimmy Carter was president that was called the Misery Index. And it was the combination of annual CPI or inflation, which the inflation report came out this morning, and we can talk about that if people have questions, plus the national unemployment rate. So back in the late 1970s, 78, 79, 80, you had a misery index when inflation was at 13, 14% and unemployment was at 8 or 9%. You had a misery index that was up to 22. It was kind of interesting when COVID hit, that misery index shot back up to 15, but almost all of that 15 was unemployment because inflation was super low. Now you see the opposite. Last year, that misery index shot up to 12, 13, but that's because inflation shot up to 9 while unemployment was at 3.5, 4. And so we've gone from the misery index being made up completely of unemployment and very little inflation to where it was made up almost completely of inflation and very little unemployment. And now we've seen inflation come back down. Now, inflation peaked last June at 9%. And today's report that came out, which was the July inflation number that was reported this morning by the Bureau of Labor Statistics, showed the inflation rate month over month went up 0.2%, but year over year moved up 3.2, which is actually a little bit higher than it was a month ago, right? A month ago it was at 3%. And what we're finding is that there are key parts to the inflation measures, including especially housing and especially wages, that are causing inflation, especially big parts of it, to remain sticky. The Fed's going to have a hard time bringing wage inflation down with unemployment below 4%. So one of the things the Fed's trying to figure out is, how high does unemployment have to go before you see wage pressures come down? Similar with housing. Now, one of the things that I think will start showing up next month or maybe the month after is just in the last, since mid-June. In mid-June, oil prices were $67 a barrel. Today, they're north of 80. And if you see, you've probably noticed it at the gas pump, prices are going back up. I think the national average is back up around 380, 390 for a gallon. If inflation starts going back up on gasoline and oil prices, and now we also know that Russia has shut down food supplies out of Ukraine again. If you see food inflation start to pick up, we could be in a really interesting position over the next 6 months where, inflation came from 9% a year ago down to 3%. But 6 months from now, it might still be somewhere between 3 and 4% if those other components either pick back up or don't roll over. And that could put the Fed in a real interesting position. So with that, I'm going to turn it over to Nathan, let him talk about earnings, and then we'll come back. I'll have a couple closing slides, and then we'll jump into Q&A.
Yeah, thanks, Jess. So one of the things that we're going to talk about kind of moving forward is a little bit, now that we've talked about some parts of the economy, let's maybe talk a little bit about corporate earnings and then what corporate earnings actually do for the stock market. And we obviously know that, corporate earnings are largely what drives or a big input into what drives long-term stock returns for the market. So let's kind of dive in on the next slide and take a look at things. So one of the key things that obviously will drive corporate earnings is the profitability of companies. Are companies actually being profitable? Well, when you think about how a company is profitable, they have the price of the good they're selling and the amount of that good they're selling, right? The volume of it. And then they also have the input that has to actually go into making either that good or servicing or service. And what this slide actually shows, which is interesting, is this is a survey of the managers of manufacturing and servicing firms, and showing whether or not the prices that they're actually inputting into making their good or service is rising or falling. And you can see they're actually falling right now. So as inflation on the input side is falling, it's costing companies less to produce their either good or service, then that's actually helping their profit margins, because frankly, prices on whatever they're selling aren't coming down at the same level. So as inputs are coming down and prices are staying relatively the same, that's actually driving a higher profit margin for companies, which should in turn eventually help the earnings. And if we go on to the next slide, a key input into really the manufacturing sector of our economy is the energy, right? The energy that it actually takes for a manufacturing plant to operate and to produce whatever their particular good is. That's a big input cost for them. And so when you see natural gas pricing falling like it has showing here, that's actually a good thing. That right now it's not necessarily reflected, right? Manufacturing, as Jesse highlighted at the beginning, the manufacturing part of our economy has been in a recession now for the last several months. Maybe a tailwind potentially going forward is as the input is going down, part of which is their cost of their energy, that could actually maybe spur part of a manufacturing rebound in the future. So that's something that we're definitely going to be keeping our eye on to see whether or not manufacturing can rebound. The services side of the economy, and this, go ahead.
Nathan, I was just going to ask you, like, and I think this is what you were alluding to, and I just want to make sure people understand, right? When inflation goes up and all the inputs that corporations are using to manufacture goods and so forth go up, people kind of get used to paying higher prices. But then when those costs go back down, like you showed in that chart, very, very rarely do companies lower prices.
Right.
So they keep the prices elevated, their inputs go down, all of a sudden their profit margins start going back up, right?
It's actually kind of funny because when I feel like when I talk with clients about it, like from the consumer side, it doesn't necessarily feel great, right? You know, you're like, oh, so you mean to tell me it's costing XYZ company less to produce it, but I'm still paying the same? Yeah, unfortunately, yeah. But from an investor side, and when we're looking at how it drives stock earnings and therefore the profitability of companies, which for shareholders of those stocks is a good thing, then yeah, that's what that means. You know, it can be good for us who are investing and putting our money to work into the stock market. From a consumer side, yeah, it doesn't necessarily mean, you know, that prices are going down on the goods that we're purchasing. So
yeah, it turns out that once companies start making more money, they like it.
Yeah, right. And I mean, it's a little bit of the and you can move to the next slide, Jess, but it's a little bit of there was a webinar that Jesse and I attended just a few weeks ago, and the speaker on that was a well-known market strategist named Sam Rines, and he talked about price over volume. And right now, one of the phenomenons that a lot of corporations have realized coming out of COVID is they actually have better margins by keeping the pricing high versus just the long and short of it is keeping prices high is better for them versus selling more of the items at a lower price. So his argument, I think, is we don't necessarily think pricing is going to come back down dramatically on stuff because companies have kind of gotten used to it. And frankly, unfortunately, we as consumers have gotten used to it in a lot of ways. So from a corporation side, until you see people stop buying your good, they have no incentive to really lower the price, right?
Yep.
So
Yep.
Turning back to earnings, I think what's interesting here is, you know, we've been through now 3 consecutive quarters. The most recent quarter that just ended, we don't have the official numbers yet, but you can see the estimate there for the second quarter. 3 consecutive quarters of earnings being negative on the S&P 500. But with what we just talked about, with companies being able to have lower input prices and passing those higher final prices onto the consumer, we do think that that's likely going to come to an end by the end of this, you know, third quarter, plus for sure, well, not for sure, most likely by the end of this year and next year. You can see the earnings estimates for the S&P are actually going to be low single digits and maybe even double digits by the second quarter of next year. So as that happens and companies continue to be more profitable, that should actually bode well for stock prices going forward.
By the way, our compliance department loves when you say most likely instead of for sure.
Yeah, right. So that's a Freudian slip on my side.
Yeah, there you go.
So one of the things when we start to look at the actual markets themselves, I think one thing that we have to pay attention to is, remember, the market is a forward-looking indicator. And the market has actually already had such a strong run in the first half of 2023 that one of the potential concerns is maybe the market already has anticipated some of this, right? That there could be better profitability in the S&P in the future, and has already priced that in, and that's why we've had such a strong run. So that is one thing to keep an eye on. I also think one of the things that we have to pay attention to is, investors by and large have really been banking that we're going to have a Fed pivot and we're going to have interest rates being cut. We don't disagree with that. I think it's just a matter of when and to what degree. And if you're really optimistic that the Fed's going to cut and maybe cut dramatically, and they don't, that could lead to some disappointment. So that's something that we're keeping an eye on. And again, I think another thing that we're keeping our eye on is so far this year, there hasn't really been much in the way of volatility. Jesse alluded to that at the beginning as well. So one of the things that an indicator that measures the volatility of the stock market is what's called the VIX. And the VIX is actually, earlier this year, it was below 13. The last time it was down that low, or right around 13, was actually February of 2020, which was right before COVID. And even now, just here in the last couple of weeks, we've had a small, couple percent pullback, but the VIX hasn't really moved up. So we're not still seeing much in the way of volatility. If there were some type of event that were to happen, or if we do spill into a recession and the VIX were to rise, you could see some additional volatility that hasn't really happened yet. Moving into the markets themselves, one thing that we have been paying attention to is, what's called market breadth or market participation. And so far on a year-to-date basis, it's actually been pretty narrow. That's this chart here. One of the things that you have to remember is the S&P 500, the number that, if you log or watch CNBC or Fox News or whatever it is, or, that you're particularly watching, the S&P 500 index is cap weighted, market cap weighted. What does that mean? The bigger companies have a larger impact on the ups and down movement of the price of the stock market. So what this chart is showing is if you strip that out, if you had all 500 companies equally weighted, what's the disparity in performance on a year-to-date basis? So you can see the fact that the market cap weighted index at the end of June was up 16, but the equal weighted portion was only up 6. What's that tell us? That tells us that really the largest companies, the top companies in the S&P 500 have really driven the performance so far on a year-to-date basis, and everything else has lagged. Matter of fact, it's really been 7 to 10 companies, and they're the names we all know. 7 to 10 primarily growth and technology companies that have driven the year-to-date returns in the S&P 500, and everything else has kind of lagged. So that's not necessarily something that we want to see over a long period of time. If we go to the next slide, to reiterate that, this shows the concentration of the S&P in the top 10 holdings, which is now at levels that it rivaled back in 2020 and is now getting close to the areas that we saw. It's not even on this chart, in the early 2000s during the tech bubble. So we haven't quite got there yet, but there is some fear out there or some concern that, as the market is really being driven by these top 10 holdings, if something were to happen, they were to miss on earnings or some other event that we don't know in the future were to happen, if you saw those 10 companies, all of a sudden take a downturn because they weight so heavily into the index, the market itself would fall as well, most likely. So to that point, I think kind of the last slide that I'm gonna hint at, and then I'm gonna turn it back over to Jesse, is one of the things that we're very cognizant of, and you can see here is you kind of want to maneuver your portfolio to where maybe the puck is going, not where it was. And so what's interesting here is the growth side of the stock market is what has outperformed so far on a year-to-date basis. That being said, that top purple line is the price to earnings ratio. And we know that in general, we want to buy low and sell high. Well, from a price to earnings standpoint, the growth stocks are now relatively expensive. Their long-term average is about 21.5. And you can see based off of this chart that they're now north of 30 or right around 30. So your growth stocks right now are expensive from a valuation standpoint, from a historical perspective. But those other areas of the market, you can see the Russell 1000 value, which is the light blue. That's your value and dividend paying stocks. The MSCI EFA. EFA stands for Europe, Asia, Far East. So that's kind of your international developed markets. And then the emerging markets. So think, China, Russia, Brazil, South America, Central American countries. Those are all actually cheap right now. Their price to earnings ratio is below their long-term historical averages. So that's just something to keep in mind when we think about where do we want to be moving potentially and thinking about with our portfolio and our investments. The growth stuff is done so well that now it's expensive relative to the rest of the market. So and with that, I'm going to go ahead and turn it back over to Jesse to kind of close us out. And
And we remember, right? Trees don't grow to the sky, right? Things don't go up. And this chart, like you see, when things that are expensive can get more expensive until they don't, right? And so we want to pay attention to that, and we don't want to be overweighted in things that are expensive at this point in time. So again, I've got 2 more slides here, and then we're going to open up for Q&A. So if you have questions, put them in the Q&A box down there at the top or bottom, wherever your toolbar is on your screen. With that, right, the other thing that we've noticed within U.S. stocks is that the large companies have become much more expensive than small companies have, right? Historically, small companies, the premium on those tend to be about 1.1 to small companies. Today, it's 1.7, 1.8. That's more expensive than anything we've seen in the last 20 years, which tells us that at some point, and doesn't tell us exactly when, but it tells us you could buy small company stocks at a much lower price to earnings ratio than what you would see for large companies that have already largely priced in that whatever future anticipation of corporate earnings and economic recovery might be out there. And then the last thing we want to talk about, this chart talks mostly about bond spreads, but I also want to talk about bond interest rates real quickly. It's this idea that historically, when you go through periods of volatility and recession, here we see 07, 08. Here's one of those big gray bars, and that's related to the financial crisis and the failure of AIG Lehman Brothers. Historically, when those types of events happen, here's when COVID happened, bond spreads blow out. The spread is how much interest bonds are have to pay over and above treasuries to attract somebody to buy them. And so back here in 09, 08, 09, the certain high yield bonds had to pay 22% higher yields than treasuries to get people to buy into them. In COVID, it got up to around 1,200 basis points, which would be 12%. But you also have to remember, at the depths of COVID, 10-year treasuries were paying less than 1%. But the one thing you'll see in this chart is that when you see spreads in this 400 to 500 basis point range, as of the end of June, it was around 421. I think when I saw it earlier today, I think it was 395. I think it was even lower than this. That tells you that there's not a lot of fear that there's going to be a lot of corporate defaults. Now, if we hit a recession, that number could start to rise a little bit. But now that the other thing you have to remember is treasuries are now paying higher interest rates than we've seen in 15, 20 years. So let's say 12 to 15 years. So if we went back, you got to remember that in December of 08, after AIG and Lehman Brothers failed, the Fed first cut interest rates to 0, and they left interest rates at 0 from December of 08 to December of 15 for 7 years. So 6-month T-bills that back in, March, April, May of last year of 22, just 16, 17 months ago, that were paying 0.5%, today are paying 5.5%. So we're actually getting yields on bonds. And remember, there's this teeter-totter where if interest rates go up, bond prices go down, and everybody lived through that last year. But if we get to a recession and the Fed has to pivot and start cutting interest rates, not only can you get this 5.5%, 6% yield on the bond funds that we're seeing today, but if interest rates go down, bond prices go up. And at that point, you get the yield plus the appreciation. And we think bonds are set up, and a number of our partner firms that sponsor the mutual funds and ETFs that we invest in think that we could see mid to high single digit, almost stock-like returns from bonds with significantly less risk. So with that, we're going to close out this section. And as always, you know how we're here to help you. You get our weekly blog posts. Hope you got to see the one this week where I got to compare the Federal Reserve Bank to one of my favorite Saturday Night Live skits. So we always try to have some fun and make economic and investment information kind of fun and relevant and more easy to read. Of course, our financial plan should be our North Star. It should be what guides everything that we do. A percentage rate of return on a portfolio is not a goal. A goal is what I want to accomplish in life. When do I want to retire? How do I want to help my kids and grandkids get educated? How do I use my money to do the travel and life things or charitable things that are important in life? That should be what drives your investment decisions, not what the latest report is out of the markets on any given day. So with that, we're going to jump into Q&A. And Nathan, do we have anything in the queue for us today?
Yeah, we've got 3. So
Okay.
I'll just jump right in. First one is, I heard that there were 10 more banks in trouble. Should I be worried about my cash in the bank?
Yeah. I at this point, if you have less than $250,000 of cash in the bank, you've got FDIC coverage, right? And that's implicit.
For married couples, it's double that.
And for married couples, it's double that, because each of them would have it on a joint account. It would be 500,000. So I don't know that many people that have more than $500,000 of cash sitting in the bank. So, if you're worried about your bank in particular and you want to move some of your money to another bank, that's an issue, that's an option. But we also know that when Silicon Valley Bank failed, right, that the average account balance, because Silicon Valley Bank was primarily venture capital, IT, and private equity firms out on the West Coast, that the Treasury Department and the FDIC basically stepped in and said, we're going to insure everybody up to their bank account limits, up to their bank accounts, regardless of the FDIC limit, which creates all kinds of moral hazard and other things. But basically, the government and the FDIC and the Treasury Department are saying, we will make depositors whole, not the people who invest in the bank, not the bondholders or stockholders, but the people who have deposits. So I'm not overly concerned at this point. If you're concerned about a particular institution and you may want to move some money if you have more than the FDIC limit, but if you're under the FDIC limit, I'm not overly concerned at this point in time.
Yeah. All right, good. Second question is, when we were talking about, I think more so directed about when we were talking about interest rates and things like that. Does that mean should we wait to buy a house, buy a car, or consider things like a variable rate?
Yeah. That's a great question. I'll address the house thing. I'll maybe bounce the car thing back to you, Nathan, in just a second here. Right. On the house side, one of the things that I always remind clients is you're marrying the house, not the mortgage, right? So if this is the house you want and this is your dream house and you can afford it and you can qualify for the mortgage, remember that if interest rates eventually come down and 30-year mortgages go from 7 maybe back down to 5 or 5.5, you can always refinance the mortgage. So if you think that sometime, like I know there's some 5-year and 7-year adjustable rate mortgages where the initial rate is lower today, And as long as you think that at some point in that 3, 5, or 7 year period of time, you can, you'll hopefully have a window of opportunity where you'll be able to refinance at a lower rate. I'm not uncomfortable with that. I don't think annual adjustable rate mortgages may be the best thing because there's just a lot of volatility and risk in those. But if you can lock in a rate for 3, 5, 7 years and then hopefully get an opportunity to refinance, I guess we don't see with the supply and inventory numbers on houses, we really don't see housing prices falling off a cliff and coming back down. So I think, in any significant way, we might see 3, 4, 5%, but you're not going to see 07, 08 type numbers in the residential real estate market, in our opinion, at this point in time. So we're suggesting people buy what they want to buy when they have the means to be able to do so. Nathan, any thoughts around the car thing? Nathan's the car guy at the office, right? Rochelle, my wife, is the car guy in our family. Nathan's the car guy at the office. I don't know anything about cars, as most people would know.
Yeah, so in some ways, I would say it's similar. And what I mean by that is I don't necessarily, from everything that I read, I don't think pricing on vehicles are necessarily going to come back down dramatically, right? As of right now, kind of goes back to a little bit about what we talked about. Unfortunately, manufacturers aren't having to. Yeah, they aren't selling necessarily quite as many vehicles as what they were in 2020, 2019, but auto sales have come back up. And more so than that, the pricing on new vehicles has gone so high that their profit margins are staying relatively high. So they're not really interested in, if you go to a car dealership today, I think for the most part, you're still going to probably pay sticker. And I talked with a client a couple of weeks back who unfortunately went to a dealership and that dealership was still charging over sticker. So if you're waiting for the price to get cheaper, especially on new cars, I think it's not probably going to happen. Now, used car market may be a little bit different than that. Part of that will be, one of the big drivers is, why did the used car market shoot up so high? Well, because during COVID, there was no new cars to meet the demand, so everybody was buying used. That will likely come back the other way a little bit at some point in time, because you'll have more, if people were buying cars, then today, 4 or 5 years from now, there'll be more used cars on the market. So you could see used pricing come down in the future. New pricing, I would be very surprised on. One last thing I'll say on it, and then we got one more question, is keep in mind, interest rates on cars are also high right now. But unlike a mortgage, the interest rate on your car, just for math, I just did it on my calculator. If you had a $35,000 loan on a vehicle, the difference between a 6% interest rate and a 3% interest rate over 60 months, over a five-year payback period, it's less than $50 a month. Is how much that, so 3% more really isn't costing a ton more in terms of your monthly payment. And since most people think about and kind of plan their lives on a monthly cash flow basis, that's just one other thing that I would say to consider, right? So.
Yeah. Well, and this goes back to what you were talking about before, Nathan, with the price over volume, right? Car dealers or car manufacturers are perfectly happy to sell 15 million cars at a huge profit margin instead of selling 18 million cars at a much lower profit margin.
That's right.
They're fine.
Yep. So. Yep. And I could go into whole spiels about, particular pockets of the auto market that have the highest profit margins are actually at like their highest sale levels. So if I'm an auto manufacturer and my most profitable vehicles are still selling for top dollar, why would I change? Why would I do anything? So there's no incentive for them. So.
All right, good. We got one last question and we're right on time. So.
Yep. Yeah, last question is with projected earnings increases and lower costs of services and manufacturing, being taken into account,
Yeah.
Has that resulted in any adjustments to the way that we at Impel manage clients' portfolios?
Yeah, well, our Investalytics committee, which is our national investment committee that consists of all of our partners from other firms within Horizon Advisor Network, actually met yesterday afternoon at this time. The report for that will probably be coming out. It's probably going to go to compliance tomorrow. So you'll probably be getting it Monday, Tuesday next week. And while we didn't make any changes this month, in mid-June, we did make adjustments to our model portfolios. And some of it was based on some of what we talked about, right? One is we trimmed growth stocks. When growth stock prices are super high, you make money by buying low and selling high. So we sold a little bit while prices were high. We continued to rotate to lower price things like dividend value stocks, international, emerging markets, and especially the international and emerging markets. If the dollar continues to fall, the value of those assets will go up, and the dollar looks like it's in a position where after 10 years of rising largely is maybe starting to go the other way. Some of that might be driven by our high debt levels and the Fed stopping or maybe stopping raising interest rates, certainly slowing on interest rate increases. But the other thing we know is that the bond side of the portfolio, we can get pretty good returns. We can get returns we haven't seen since early 2000s on bonds, where we can actually get 5-6%. And again, if the Fed cuts interest rates, those bonds will go up in value, and then you get the interest rate yield and the price appreciation. So all of those things were recently taken into account with the adjustments made to our model portfolios. And that's not necessarily based on what did well over the last 12 months. Going back to Nathan's analogy of we want to skate to where the puck is going, not where it's been. It's kind of on our perception of where things are headed. Those things have been taken into account in our model portfolios. So with that, I know we're right on time, but our marketing and PR people will have a conniption if I don't come back after our disclosures and remind everybody one more time to save the date for Tuesday, September 26th. You'll be getting the information on it. We want to sell this out. I think we have 250 seats available. It's going to be a great event. It's going to be a lot of fun, and we'll certainly look forward to seeing you there. So look for that, save the date in your calendar, and we'll have a great time together. So thank you to everybody who joined us for today's event. We hope this was great information. As always, if you have questions about your particular situation, give me, Nathan, give Irene a call. That's what we're here for, and have a wonderful day. Thank you so much.
Take care.
Bye-bye.